Scholar, today we are going to talk about chapter 13, a stockholder's equity. As you remember, in our balance sheet equation, asset is equal to liabilities plus equity. Today, we are going to talk about this equity portion of the balance sheet. So we have discussed long-term assets and short-term assets. We have discuss long-term liabilities and short-term liabilities, and today we are going to discuss equity. And before we discuss equity, we're going to revisit our topic of corporation that we have discussed in chapter number 1. So in chapter number 1, we discuss that corporation is a business organized under state law. So we are basically organizing a business under a state law, whichever state it is. If we are in the state of Texas, that we're going to use state law for the state of Texas. A corporation, number 1, is a separate legal entity. Means it is separate legal entity from its owner. So for example, if you create a corporation and somebody sued your corporation, they cannot sue you because you are the owner. They're going to sue the corporation because it's a separate legal entity. Corporation dominate business activity in the United States. All the large and mid-sized to large corporations, businesses are corporated or corporations. Most well-known companies are corporations. Characteristic of a corporation: they are separate legal entity. They have numbers of owners, what we call them shareholders or stockholders is the same thing. No personal liability of the owner means if a corporation, say for example Walmart, gets sued, nobody is going to come after you because you are holding, say, 10,000 shares of Walmart. Indefinite life. Their life continues as long as the corporation exists. And there is a double taxation. Why is the double taxation? Because it's a separate legal entity, so they have to pay a tax. And when the shareholders receive dividends, they have to pay a tax on the dividend income as well. Capital accumulation. We're going to discuss all these things in a minute. So here are the advantages of the for the corporation. Limited liabilities. Shareholders of a corporation has limited liability for companies' debts and obligation. This means that their personal assets are protected. Personal assets of the shareholders are protected from the company's financial liabilities, and they're only at risk of losing the amount of money they have invested in the corporation. For example, you have purchased 1,000 shares of Walmart and you paid like $50. So you have $50,000 invested in the corporation. If the corporation goes bankrupt, the only thing you're going to lose is $50,000 that you have invested in the corporation. Perpetual existence. Corporations can continue to exist. For example, you know about Ford Motor Company. They started around 1900. We are in 2023, so they have been in business for the last 123 years, and we hope that they're going to be in the business for the next 50 or 100 years. Even if the original founders, the Henry Ford, has no longer with us. This means a company can continue to operate and grow even after original owners retire or sell their shares. Ability to raise capital. Corporation can issue stocks to raise capital. This is basically a capital accumulation, that anytime a corporation wants to expand or they want to involve in any other kind of business venture, they have the tool available to them. They can issue more stocks and raise capital, which can be attractive to investors looking to invest in a company. Because, for example, if a company is allowed to issue 100,000 shares and they have already sold all the 100,000 shares, and there are people out there who are interested in investing in business, selling more shares would be a very profitable venture to do that. Additionally, corporation can also borrow money from banks or issue bonds to raise additional capital. So not only they can issue stocks, they can also issue debt in the name of bonds or long-term notes payable, and they can raise capital. Transferability of ownership. Shares of a corporate are easily transferable. For example, if I want to purchase 100 shares of Walmart, I can purchase it and I can sell it next year, 50 shares of Walmart. So buying and selling of shares of publicly traded companies are very, very easy. You can do it with a click of button by just moving a couple of fingers. Transferability of ownerships, and then professional management. Corporation often have a more professional management, so that management is different from the owners. So owners, the shareholders, elect board of directors, and these board of directors, around 15 to 20 board of directors, they hired professional management such as CEO, CFO, CIO, COO, and these managers, professional manager, runs day-to-day business of the corporation. Tax benefit. Corporation can take tax advantages of certain tax benefits, such as being able to deduct certain business expense, offering tax deductible benefits to employees, and being able to choose the most favorable tax structure for the company. Tax benefits, all you need to remember, they have certain tax benefits. For example, if they are building everything in United States, they have certain tax breaks available to them, like local corporations. Means Toyota company, for example, if they're importing their engines from Japan and assembling the cars here in the United States, they cannot have those tax breaks. But the local corporations who are doing, for example, Ford Motor Company, building everything over here, that's they can deduct those expenses. Offering tax deductible benefits to employee. For example, if the employee decided to invest in 401k, they can save some tax on it. Overall, forming a corporation can provide a range of benefits for businesses looking to grow and expand, including limited liability protection, access to capital, and a professional management structure. So these are the advantages of having a corporation, but there are certain disadvantages. Double taxation, as I said, you have to pay tax twice. Once the corporation is going to pay tax on their income because they are a separate legal entity, and then once the shareholder receive dividend in the name of profits, that shareholders will also have to pay tax. This can result in lower net income for the corporation and less money for shareholders because you are paying twice the tax. Higher cost. Corporation have higher administrative cost because if you are running your own business, you're not going to charge that much money. But if you are hiring professional management, that could be anywhere 15 to 20% of the cost of doing business. Lack of flexibility. Corporations have more formalities and governance requirements than the other entities. It's a lack of flexibility when it comes to decision making, and can slow down the pace of business. Means when there is a layer of management one after another, anything cannot be quick, decisions cannot be made very quickly, and requires a lot of approval from different people. Legal complexity. Are subject to complex legal requirements which can be costly and time consuming because you have to involve accountants, you get to involve lawyers and other professionals in order to provide any expansion you are making, opening a new factory or introducing new projects, and you have to get a sign off from various federal agencies such as OSHA and EPA. Shareholder pressure. Are owned by shareholders who have a say in how the business is run, and that can create pressure to focus on short-term profits. So board of directors usually put a lot of pressure on the management to have focus on short-term profits. When we're talking about short-term profits are publicly traded companies have to meet their goals on a quarterly basis. So every quarter there is a pressure on them to meet certain goals. Overall, corporations offer many advantages. They also have some significant disadvantages that should be carefully considered. And therefore, that's why, because private companies do not go under that much trouble, and that's why sometimes publicly traded companies or publicly traded corporations goes private. Stockholders equity basics we're going to discuss. Maximum number of shares of a stock corporation may issue is called authorized stock. So who gives the authorization? Comes from Secretary of State. Every state has a Secretary of State. So our Secretary of State is in Austin, Texas. And when you registered your corporation in the state of Texas, means you go to Austin for that. The Secretary of State, based on all the documentation you provide, they tell them how many shares you can potentially sell. And it is different for different company. The rules are the same, but based on the rules, every company will get authorized different. Some may get 100,000 shares, some may get 300,000 shares. Issued stock has been issued by the corporation. So the idea, the phrase issued stock, authorized stock, these are the things that you need to know. Authorized stocks, you are the total number of shares a company can sell. Issued stocks is the number of shares that a corporation has already issued, is in the hands of the shareholder. So I just put it over there, in the hands of shareholder. Okay, a stock held by is called outstanding stocks. So issued stock means the stock has been sold and they are outstanding stocks, is in the hands of the shareholders. Okay. Stockholders are issued stock certificate, just like bond certificates. Capital stock represents a stockholder's ownership. All right. So basically, first you have authorized stocks, and then comes issued or outstanding, and then the third one we're going to talk about is a treasury stocks. We're going to talk about in a minute. So what are the rights of a shareholders? They have a right to vote, they have a right to get dividends, and in case of liquidation they should get their money back, and they have a preemptive right. So let's talk about what each share of basic ownership in the corporations carries one vote. So for example, if you own 1,000 shares of Walmart, and if you go to the election of board of directors, you as an individual not only has one vote, you have 1,000 votes. So every share equals to one vote. Each share equals one vote. Just like as an individual, when we vote in our local elections or federal government elections or state elections, as an individual we have only one vote. The same way, each share has one vote. So if you own 1,000 shares of Walmart, you're going to have 1,000 votes in your hands. Dividends, a stockholder receive a proportionate part of any dividends declared and paid. Who declared? Board of directors. So board of directors, we're going to discuss this later in this chapter, but board of directors announce the dividends, and then the shareholder receive it in a month or so. Liquidation, the shareholder receive their proportionate share of any assets remaining after liquidation. So for example, liquidation simply means you sold all the assets, pay off all the liabilities, and whatever left will go. So for example, your 1,000 shares represent 1% of your ownership in a business, and after selling all the assets and after paying all the liabilities, the 100,000 left. So as a 1% owner, you would get 1% of 100,000, which is $1,000. It is very much possible that initially you purchase those 1,000 shares for $10 a piece, of which is $10,000, but in the end you only receive whatever is left over. Preemptive rights, shareholders or stockholders, the same thing, have a right to maintain their proportional ownership. For example, you are 1% owner of Walmart. If Walmart is issuing new shares, they will ask you, okay, we are issuing 100,000 more shares. You have 1% total interest or ownership in the Walmart. Would you like to purchase another 1,000 share so you can keep your 1%? Because if you do not purchase, your share will go from 1% to 0.5%. So they will give you the first right. If you accept it, you can purchase those 1,000 shares and then keep 1% of your ownership. If not, then we'll go to the next person. Capital stocks. Corporation issue different corporation issue different classes of stocks. Common stock and preferred stock are the two more common. Common stock also comes in a different flavor, and preferred stock also comes in a different flavor, and we're going to talk about a little bit more in detail. A stock may carry a par value or maybe a no par stock. So they may have a par value, or par value, as you know, as a face value, and a no face value. Okay. A stated value is no par stock that has been assigned an amount similar to par value. Now we're going to discuss this a little bit later in that chapter. A stockholder's equity. A corporation's equity is also called stockholder's equity. So corporation's equity, stockholder's equity are the same, has the same meaning, no difference. Two basic sources of stockholders' equity are paid in capital, represent the amount received from the stocks, and retained earning is the equity earned by profitable operation that is not distributed to the stockholder. So basically your equity has two parts: common stock and retained earnings. The common stock could also be preferred stock. All right, so these two plus the retained earning. Some companies have only common stock, some companies has both common stock and preferred stock. Okay. Issuance of stock. Companies raise capital by issuing a stock, we have already talked about. A company can sell its stock directly to stockholders, or it can use the services of an underwriter. Means underwriter is a third party that you can hire. It's usually a bank that can help you sell. Stocks of public companies are bought and sold on a stock exchange such as New York Stock Exchange or NASDAQ. The issue price is the amount of corporation receive from issuing a stock. For example, a corporation sale, I am selling 100,000 shares, and every share is $10. So that's, they receive $10 multiplied by 100,000 is about $1 million. So issuing a stock at par value is somewhat rare practice in modern times, as many companies issue their stock at a price that reflects the market demand for their share. So who comes up with the market demand? The company uses the services of that underwriter. That underwriters study your company, and it tells you that the public would like to buy your share, say for $15, for $18, for $19, depending. So the underwriter will tell you. And sometimes what happens, even though underwriter say your share would sell for $15, in most cases it sells more than $15. In rare cases it could sell less than $15. It because how the market demand is, or how market perceives your company. In majority of the cases, the public has a very optimistic outlook for new shares. Okay, some companies may still issue stock at par value for various reasons, such as legal requirements or historical reason. Here is an example of issuing a stock at par value. Let's say a company named XYZ decides to issue 1,000 shares of common stock at a par value of $1 per share. This means that the total par value of the stock issue would be $1,000. So how does it work? Let me show you over here. So this is XYZ Corporation issuing 1,000 shares of common stock. All right. However, they are saying that the par value of $1. So when they are saying $1 par value, so what they are saying that here is a common stock, it has a par value is $1. All right, that creates another thing is called additional paid in capital, and that is $9. One plus it's 9 is $10. For example, why I'm saying that the price of common stock is equal to $10, that $10 will come from here. So how we going to do? We're going to say debit. We sold we say debit cash. We are selling 1,000 shares at $10 value, so we can call it $10,000. But we're going to credit, we're going to say common stock are, since it has a par value, so it's for $1, so that's $1,000. And we're going to credit another column, another account, which is additional paid in capital, and which is 1,000 shares multiplied by $9 is $9,000. So we have created two accounts because we are issuing 1,000 of common stock with par value, and the par value is the same as face value. So what we are saying is that the face value of our common stock is $1, but the price that we are receiving is $10. So people are willing to pay $9 extra for a common stock that has a face value of $1. Okay. When the stock is first issue, XYZ Corporation will offer it invest at a price that reflects the current market demand of the shares. So in this case, we make up a price as say $10. If the market value of the share is higher than the par value, the company may sell the share at a premium above par value. If the market value of the share is lower than the par value, the company may sell shares at a discount below the par value. For example, if the market value corporation is $50 per share at a time of issuance, the company may offer share to investor at a price of $50 per share, meaning they would receive $50,000 in total for the issuance. The $50 per share reflects the current market demand rather than the par value of $1. So basically what we are saying in this example, their face value is $1 per share, but the people are willing to pay you $50. That means they are paying you $49 above the face value of the common stock. And the reason they are doing it because they expect the share price of this share of XYZ Corporation will go above and beyond $50. Overall, issuing stock at par value is relatively uncommon practice in modern times, but it can still occur for various reasons. In most cases, our company will set the price of the share based on market demand rather than setting a par value. We are discussing this so you have an idea how this business of selling the shares used to work and how it is working as of now in the current times. Issuing common stock at a premium. Issuing a sub means that the company is selling its share at a price higher than the par value. The example that we discussed before. This usually happens when the market demand for the company stock is high and investors are willing to pay more. Another example is the same example that I have used. ABC Corporation issue 1,000 shares of common stock with a par $1 per share. However, due to strong demand from investor, the company decides to share a premium of $50. You can read the rest, and it will be the same for that as well. Issuing no par common stock. No common stock is that does not have a designated par value. So it has no par or face value. Okay. Example, let's say the company XY decides to issue 1,000 share of no par common stock Unlike traditional car, this stock does not have a par value attached to it. Instead, the company will set a price based on market demand at the time of issuance. So for example, if they are selling the market price is $50. Number of shares sold is 1,000. So how much cash are you going to get? You're going to get cash $50 multiplied by 1,000. That's $50,000. But you're going to credit only common stock for $50,000. In this case, there would be no additional paid in capital. So this thing, additional paid in capital, will be part of par value stocks, part of par value stocks, but this one is no par value. When no par value means no additional paid in capital. Okay. And it's stated is a type of a stated value common is a type that has designated stated value that is below the market value of the stock. Okay. Represents the minimum legal value of the stock and is used to protect the shareholder in the event of bankruptcy or legal issues. So if something happens, they have to at least provide you the stated value. Here is an example of issuing a stock. Company name ABC decides 1,000 shares of the stated value common stock at $1 per share. However, the market value stock is actually 15 due to strong demand from investor. This means the total value of the stock is $50,000. However, the stated value is only $1, meaning that the company is legally obligated to maintain at least $1 in value in the event of bankruptcy or other legal issues. So what's going to happen? It still is the same thing. Debit cash that you are receiving is $50 for $1,000 is $50,000, and you're going to credit common stock for $1 because the stated value is $1. So it's $1,000, and your additional paid in capital will be $49,000. But keep in mind, you have to always maintain this much cash, this cash. So this $1,000 should be available all the time to the corporation in case any holder of this share wants to sell back their stock, and they should be able to get it $1,000 value. And that is the idea of a stated value. And there is a concept, if you want to Google it, it's called piercing the veil. If you're interested, you can read about it by Googling it, piercing the veil. Sorry. If the company were to go bankrupt, the stated value per share would provide some protection to shareholders who would be entitled to receive at least $1 per share before any remaining assets are distributed. So what I told you in the liquidation, I told you that if you have invested, say, $10,000 in the corporation and the corporation go bankrupt, you would lose everything. But if the shares says they have a stated value of, say, $1, then the $10,000 that you have invested, you must have received $1,000. So if they are par value or no par value, you will not receive it. But if they have a stated value, you will receive this $1,000 or whatever the value of the stated or face value at that time for the shares. Issuing a stated value common stock provide legal protection to shareholders. That's the only thing they do. Issuing common stock for assets other than cash. So other than cash, for example, land, building, equipment, furniture and fixture, machines, it could be anything. So that will be how it's going to work. Companies can issue common stock in exchange for assets other than cash. This is a non-cash transaction and can be used to acquire assets such as property, equipment, other business. Example is, wants to acquire a smaller competitor named ABC Corporation. Instead of paying cash, that decides to issue common stock to the shareholders in exchange for their share. So if you read business news, business part of the Wall Street Journal or Financial Times or Economist, you will notice that one business is buying another business, either using all cash or using all stock or using part cash and part stock. So that's how these transactions work. So the current market value of the XYZ is $50 per share, meaning that the total value of transaction would be $50,000, $500,000, 10,000 shares per 50,000. In exchange for the shares of XYZ Corporation, shareholders of ABC Corporation transfer ownership their company to XYZ Corporation. So they are accepting the stocks from a competitor and selling their company to them. This type allows XYZ to acquire ABC without having to pay cash for this, acquiring the another asset. Instead, can use the stock as a currency, which can be flexible, efficient way to finance these acquisitions. However, companies must be careful to ensure the value of the assets being acquired is accurately reflected in the value of the common stock being issued. It means if you are giving up $500,000 worth of shares, that means you should be receiving something of a value that is almost equal to 500,000. It could be 499,000 or 501,000, few thousand plus and minus, but it should be equal to market value equal to $500,000. You cannot do it if you giving up $500,000 but receiving something a value of $200,000. Issue preferred stock is a type that typically pays a fixed dividend and has a priority over common stock. So basically, what kind of priority we are talking about? We are talking about priority of receiving dividends. Preferred stockholders receive fixed dividends, and they receive dividends before common stock receive dividends, or even in the event of liquidation or bankruptcy. Example is ABC Corporation wants to raise capital to find new project. The company decides to issue 10,000 shares of preferred stock with a value of $100 and annual dividend of 5% of what? 5% of $100, which is $5 a year. So they are saying that if you purchase our 10,000 shares for $100 per share, we will give you 5% dividend each year. Investors are interested in preferred stock because it offers fixed dividend that is higher than the current interest rate or the investment. For example, right now the interest rate is around 5%. So the investors have a choice. Do I want to put my money in a CD or do I want to put the money in the share? So that kind of opportunity investors always look upon. So the total value of preferred issuance is 100,000, 10,000 multiplied by 100. ABC can use proceeds from issuance to fund new project. Over time, pays out annual dividend of 5% to the preferred stock. If the company were to go bankrupt or be liquidated, holders of the preferred stock would have a priority over holders of common in terms of receiving any remaining assets. So what's going to happen? Suppose this company goes bankrupt and they sell all their assets. They pay off all their liabilities. Now something left over, say $50,000. That $50,000 first go to satisfy the need to the preferred stockholders. If anything left over, then it will go to the common stockholders. Issuing preferred stock can be an effective way for companies to raise capital while also providing a fixed income to investors. However, it also means that company must pay out regular dividends, which can limit financial flexibility. Okay. Purchase and sales of treasury stock. What are treasury stock? Treasury stock is a company stock that has previously issued and later required. So for example, you are a corporation. You are authorized to sold 100,000 shares. You have already sold all the 100,000 shares, but you need to buy back some of the shares for one reason or the another, and you are buying back. Once you buy back those shares, you keep it under a treasury. Okay. Companies purchase treasury stock to increase net assets by buying low and selling high. They support the company's stock price, avoid a takeover, and reward values employed with the stock. Because reward how? So sometimes, when a company pays out a bonus, so instead of bonus, they give the employees stocks. And sometimes somebody say, if you work for us for 2 years, we will give you 1,000 shares. So that's how sometimes they don't have the shares available to them, so they have to buy those shares from the market and pay to the employees. Treasury stocks the basic accounting of treasury. The treasury stock count as a normal debit balance. Treasury stock is a contra equity account. Treasury stock is recorded at cost without reference to par value. Treasury stock account is reported beneath retained earnings on the balance sheet as a reduction to equity. So I'm going to show you. Suppose here is a T account for equity. First goes the preferred stock, then goes the common stock, then goes the additional paid in capital, and then goes retained earnings. So this is on the credit side, but this is the debit side. The treasury stocks are listed over here because they are the contra account that reduces the true value of the equity. Okay. Purchase of treasury stocks. Treasury stock refers to shares owned stock that have been repurchased by the company and are being held in treasury. Example, that company has issued 100,000 shares of common stock, of which 10,000 shares were repurchased by the company and held treasury stock. The company decides to purchase an additional 5,000 shares of its own stock from the market. The market price of the company's stock is $50 per share, meaning that the total value of the purchase would be 250,000. Because of what they're going to say, that we can say debit treasury stocks. We are buying how many? 5,000 shares. 5,000 shares, and we are paying for how many? How much money? We are paying $50. So we are paying them $250,000. What we're going to credit? We're going to credit cash of $250,000. So that's how, when you purchase treasury stock, that would be the journal entry for it. After the purchase, company now has 15,000 shares of treasury stock. These do not pay dividends, do not vote, and not considered to be outstanding shares. So it's a very important point. Treasury stocks do not get dividends, they do not get to vote, and they do not consider to be outstanding. Outstanding shares are only in the hands of the shareholders. In the hand of shareholders. All right. However, the company can reissue these shares in the future to raise capital or use them to pay employees or executives. So you have 15,000 shares. If you want to sell them at a later point, you can as a corporation. And if you want to give away as a bonus or any other executives or employees, you can also do that. One potential reason for companies to purchase is the signal the market it believes the stock is undervalued. That's a very important point you need to remember. Another reason might be to reduce the number of outstanding shares, which can increase the earnings per share for the remaining shareholder. Earnings per shares are calculated this way. Net income minus preferred stock dividend divided by number of shares outstandings. This earnings per share ratio is very important for companies because a lot of investors value your company based on what kind of earnings you are providing per share. So that's the reason people want to know how much money a company is making. Whether they are paying a dividend or not, it's not about dividends, how much a company has made. So for example, the company net income is say $115,000 and they paid $15,000 dividend. So that number is 100,000. But if their outstanding share is 10,000, which means the company has produced or provided $10 per share, which is equal to $10 per share. So your earning per share is $10, which is definitely higher than somebody has $2 or $5 or $7. However, companies must also be careful when purchasing their own stock, as it can seem as a risky financial maneuver if not properly managed. Too much reliance on treasury stock purchase can lead to financial instability and a lack of confidence in the company. Majority of the financial decisions that you're going to see companies make usually has both positive and negative effect. How much you want to do. It's very much like drinking, right? People like to enjoy alcoholic drink, but how many drinks you should have? 1, 2, or 10. So if you ever drink alcohol, you know that if you drink 10 alcoholic drinks one after another in a span of like 2 hours, it will have some negative impact on you. But if you drink 1 or 2, it may not. The same thing goes with corporations. So these corporations can do these things, but if they do too much or too many times, it could have negative consequences on the credibility or on the financial statements of the corporation. Retirement of a stock: may retire is a stock by canceling the stock certificate, but you have to purchase first. Retired stock cannot be reissued. Treasury stocks can be issued, but retired stocks cannot be issued. So it's an important point. Remember it. To purchase previously issued stock for retirement, we debit the stock account and credit cash. This also removes the retired stocks from the company's book. It also reduces the total assets and total stockholders' equity because you paid off the cash, and also reduce your equity by removing or retiring those shares from your equity. Dividends. A profitable corporation made distributions to stockholder in the form of dividends, can be paid in the form of cash, more stock, or other properties. Legal capital refers to the portion of stockholders' equity that cannot be used for dividends. These dividends, always remember, dividends comes from retained earnings. Always remember that. Anybody ask a question, dividend do not come from net income. Doesn't have anything to do with cash. Dividend always comes from retained earning. 3 important dates: declaration date, date of record, and payment date. Declaration date: the board of directors announce that there will be a dividend. And keep in mind, once the board of directors announce this, they cannot go back on it. They have to pay out that dividend. Date of record is this. So for example, this is December 15, and the payment date, it says this February 15. So this one may be somewhere around 10th. They will tell you that the date of record is February 10. The record simply means they're going to make a list of all the shareholders as of February 10, end of the business day, that who owns the stock, and those people will receive the check, or the check will be mailed to those people on February 15. Okay. Declaring and paying dividends to the preferred stock people. Each dividend rate on preferred stock is often expressed as a percentage of preferred stock, such as 6%. 6% simply means if the face value of a stock is $100, then people will receive 6%. Sometimes cash dividends on preferred stock expressed as a floating dollar amount, for example, $3 per share. So instead of percentage, they can use also a dollar amount. A preferred stock in arrears is a dividend that hasn't been paid for the year. Preferred stock comes in 2 flavors: cumulative preferred stock and non-cumulative preferred stock. Cumulative preferred stock simply means if you didn't get the dividend, you will get the dividend. If you didn't get the dividend this year, you will get the next year. But in the non-cumulative, if you didn't get the dividend this year, you lose it. A stock dividend is a distribution of corporation owned stocks to a shareholder. So instead of property or cash, they're just giving you more stock. So for example, you own 100 shares of Walmart, and the Walmart said this year we're going to give you 15% stock dividend. It simply means you own 100 shares, so you will receive 15%, which means you will receive 15 additional shares. So your shares, instead of 100, after that dividend will be 115 shares. And they have the following characteristics. They affect only stockholders' equity account. They have no effect of total stockholders' equity, and they have no effect on assets or liability because you're not using any cash or any other asset. Why issue stock dividends? Company issues stock dividend in order to continue dividends but conserve cash, means they don't want to use the cash, reduce the market price per share of its stock, and reward investors. Recording stock dividends, they have a declaration date, record date, and a distribution date. A small stock dividend is less than 20% to 25% of the issue. A large stock dividend is 20% to 25%. So for example, what does it mean? Means if a company has 100,000 shares and they are giving 15% or 18% stock dividend, it will be considered a small stock dividend. And if they're giving 25% or 30%, it will be considered large stock dividend. A stock is split is fundamentally different from a stock dividend, and both are two different things. A stock split increases the number of issued and outstanding shares. A stock decreases the par value. So for example, you have 100 shares and the company says that we are going to give you 2 for 1, which simply means they're going to double the number of shares you have. So you have 100 shares. After that split, your shares will become 200. But before the split, the par value of your share was $1. Now the par value is going to be 50 cents. Complete corporate income statement also have two options: continuing operation and discontinued operations. So you have to mention these two. Earning per share, as I discussed before, is most widely used for all business statistics. Report the amount of net income for each share of the company's outstanding common stock. Is calculated net minus preferred dividend divided by the weighted average of common stock share outstanding. Okay. Reporting equity for a corporation. Retained earning reports how the company retained earning balance changed from beginning period to ending period. Remember, we show you this. So we have this formula T account for retained earning. We have a beginning balance. We add the net income. We subtract the dividend, and that we have ending balance of retained earnings. That's it. Companies can report a negative amount. Retained earning is called deficit. The balance will appear over here if it is a deficit. If there is a net loss, the net loss will appear over here. So there would always be either net income or net loss. It cannot be have both. Appropriation. Cash dividends and treasury stock purchase require a cash payment. Bank often require a company to maintain a minimum level of stockholders' equity. Appropriation of retained earnings are retained earning restrictions recorded by the journal entries. So whatever restrictions if you have on it, it will be reported in your financial statement. These are basically notes to the financial statement. Majority of your questions in this chapter will come from purchasing and selling of stocks and dividends for common stock and preferred stock. Okay, so this is the end of our lecture for chapter number 13. Please let me know if you have any question. Also, I have posted lecture videos from the publisher, as well as also have post a lecture for a comprehensive problem for this chapter. So if you watch all 3 of these videos, it will really help you understand this chapter. Again, thank you very much for watching this video, and I hope to see you in the next chapter.